You profit from online dating. I'm going to show you how with a presentation on Match.com. My name is John Zolaitis. I'm the president and founder of Covatus Capital, and we are a registered investment advisor in the state of New York. This video is not an advertisement. It's not a recommendation. And you should seek advice on your investments from a professional advisor. Lastly, I'll disclose that we are long Match.com as our accounts managed by Quovatus Capital. So, what is Match.com? You can see the beautiful chart there. It's a company that went public in 2015 as part of Interactive Corp, split in 2020. And you probably know it. It's the largest operator of apps for online dating, including Tinder and Hinge, 3.5 billion in revenues, and about a $12 billion enterprise value. It does pay a small dividend, 2% yield, which is somewhat rare for a tech stock. Just to put some things in context, Tinder is really the vast majority of the business. Hinge, fast growing, but still quite small. And then it has a bunch of other things like Match.com, Plenty of Fish, etc. Is Match a good business? Well, when we look for stocks to own, our first criteria is whether the business is a high quality business. We don't want to own garbage. And in this case, we've got mid-single digit revenue growth as the target and 39% adjusted EBIT margins, which are extremely high. This is a business where scale matters. You have 90% brand awareness for Tinder. And there are switching costs when you're looking to be a customer for online dating. You want to be in the pool with the greatest number of other fishes. It has a recurring revenue subscription model and generates a huge amount of free cash flow right now, looking at 11% free cash flow yield on 2025, returning all of the free cash flow to shareholders. Let's take a look at a metric that I think is especially interesting, which is the conversion of revenue to free cash flow. So for every dollar of revenue that Match.com generates, it's producing 30 cents in free cash flow. So a dollar of revenue for Match is worth more than something coming from another business. For example, Walmart's free cash flow conversion is more like 4%. Why is there an opportunity in this stock? Well, the big problem is that Tinder is losing customers, especially among the important Gen Z cohort. Paying customers on Tinder is going down, and essentially the street looks at that and says, this is the biggest profit contributor, and you can't turn this thing around because Tinder is broken. So therefore, we're trading this at a very low multiple. Um, our investment thesis is that new CEO um, came in February, and this person, Spencer Radkoff, is a catalyst for cultural change. And the main thing he's trying to do is shift the company from its previous focus on monetizing the users to a new focus on creating the best outcome for people using the app. And so think about this as a consumer of any kind of business, and I'm a consumer analyst really more than a tech analyst. When the CEO and the business focus on improving the results, the experience for the user, for the customer, that is dramatically better than asking the question, how can we profit from people on our network? We think this shift, which is underway, will lead to better user engagement, higher revenue growth, and we calculate a potential double or more in the shares over the next year and a half based on what we think can happen. Looking at that just the other way, we think the stock is being viewed as a melting ice cube. And in this scenario, basically, you've got the equity value trading at less than 10 times this year's free cash flow. The market's saying this free cash flow is going away. On the other hand, we think if Tinder metrics turn, so they stop losing users, then the market will change the way it's valuing the business to reflect the high quality and the free cash flow that it generates, hence leading to very big investment returns. So first question is online dating just over? Like, is Tinder done because people just are finding other ways to meet each other? And what the results with Hinge show, which is owned also by Match, is that that's not true at all. Hinge in a recent quarter had 25% revenue growth and added 18% new payers. So the conclusion here is not that online dating is over, it's that users want a different experience. So who's this guy, Spencer Raskoff, that we think is going to help turn this around? I mean, basically, the guy's an ass kicker. That's the way we see it. I mean, he started multiple businesses. And he started Hotwire in 1999, which he sold to Expedia. He started Zillow, made 17 acquisitions. He started a family office in 2020, incubated 8 companies. He's on the board of several high-name businesses. And I will point out that he has a skin in the game. He promised to buy $1 million worth of Match.com stock when he started. Instead, he bought 2 million just to get going and currently owns about 5.5 million bucks worth of shares. So how are they going to fix Tinder? First thing was he reduced a lot of layers of management to try to keep the business lean and also to allow it to move more quickly. And secondly, like, hey, you've got a business working with Hinge. So let's just bring over the things that are working there and put them into Tinder. But the main things more specifically that I would relate to you that I think are very encouraging are number one, improving the authenticity of the user base on Tinder. So, for example, they're requiring ID and Face ID for users to remove people who have fake accounts, remove robots, remove bad actors, improve the authenticity of the experience and safety. Second, find ways to make Tinder more compelling, more engaging. An example of this is Double Date, where instead of going on a one-to-one date with your potential match, you can go with 4 people altogether, and this is intended to reduce the stress and anxiety associated with these meetings. And not everyone's going to choose this, but you're finding ways to bring people together, which reinforces the value that Tinder is bringing to the user. And lastly, and this is the part I think you should think about the most, which is using AI to improve the product offering and the way it works. So if you're not an investor directly in AI chips or the big tech companies, the secondary way to think about AI as an investment theme is to look for what kind of businesses can utilize AI to improve their business model. And Match.com is an obvious case because you have tons of data, you have all these qualitative elements, and you're trying to solve for how do we find the right people to bring them together? What's the success? How do we improve the success criteria of our user base? And so, 2 examples here. With your permission, AI will mine your your photos to find the best photo montage to to put onto your profile. Secondly, when 2 people come together in a chat on the site, AI is using data and information out there to help conversation prompts to get people to speak to each other. But ultimately, it's about taking this new technology and applying it to the business here to improve the structure and the outcome. And I think there's really a case that this can be done here. Now, what's the data? What do we have any KPIs showing improvement? Yes. So they have something called a six-way chat, which is when there are six different exchanges between two people, which they've um, uh, called Sparks. And they're seeing an improvement in that among the user base, although the total number is declining year over year because you have fewer users on the platform. But what this shows is that the engagement of the existing user base is increasing, and I believe is an early sign that we're going to see a positive inflection. What should we pay for Match.com? Well, first of all, I just want to point out this is not an expensive stock. It trades at 9 times EV/EBITDA, and other companies with a similar margin structure trade at much higher multiples. Again, it's the Tinder losses in customers that are driving this cheap valuation. On the other hand, what could it be worth in the future? Well, if we use our 2027 targets, consistent with the company's guidance, and a multiple of 12 to 15 times on EV/EBITDA, that gets you $66 to $85 a share, which is 92% to 147% above where the stock traded closed on Friday, which is 34 bucks. Now, how realistic are these? Well, I think 12 to 15 EV/EBITDA multiple is a very reasonable multiple for a business of this quality, but needs to be showing growth, and that's what's not there right now. So, in summary, you've got the largest operator of dating apps with Tinder and Hinge, among others. Very high quality business from a financial perspective. Losing subscribers at Tinder, which set up the opportunity. We like the new CEO, his background, his approach, the inflection in the company's focus on the customer and good outcomes for the customer rather than monetizing the customer. And we believe this will lead to a positive inflection in Tinder metrics, which should re-rate the stock higher, more in line with its financial profile. In that scenario, we think the stock could trade really 100% higher or more in the next year and a half. And as a margin of safety, you can look at the strong free cash flow and the return of excess free cash flow to investors as protecting you on the downside. Of course, there are some risks to the business. Lastly, I would just mention our philosophy. We look for stocks to buy when the good news isn't priced in, rather than buying when the bad news is priced in. And we do look for a margin of safety, which we think is in this case. Lastly, if you enjoyed this presentation, please hit like. You can subscribe. I also write a monthly investing letter, which you can subscribe to via the QR code here. And thanks so much for watching.